We're coming off a disappointing NFP showing in the previous month, though overall there has been no change to an all too familiar story in which NFPs and the unemployment rate are broadly tracking in areas that would easily justify further upwards rate adjustment from the Federal Reserve, if not for ongoing subdued hourly earnings and bigger picture downside risks to the global economy. The biggest takeaway into 2019, as it all relates to the direction of Fed policy, is that the Fed has once again bent to investor sensitivity, catering to calls for a shift back towards what has been a very well-received monetary policy accommodation bias. This bias has fueled stocks back towards the late 2018 record highs, given the Fed's green light to be buying risk on good news and bad. If the headline data comes in strong, investors feel good and know the Fed will still be sensitive to other risks that will keep it from shifting more aggressively to the tightening side. If the headline data is weak, even better, as it provides additional reassurances that lower for longer policy isn't going anywhere anytime soon. Of course, all of this assumes there is no dramatic uptick in those hourly earnings reads, because the one thing that could change the picture is an indication that inflation could be about to shoot up out of nowhere. If this happens, the Fed will be in a much tougher position with respect to being able to justify accommodative policy, and this will not be good for investor sentiment and the U.S. and global equities markets. By extension. Looking at the data, the expectation for NFPs is 180K up from 20K previous. The unemployment rate is expected to hold steady at 3.8%, while hourly earnings are forecast to tick up month over month and remain unchanged year over year. That's all for now.